Welcome to this special monetary policy edition. The minutes of the monetary policy meeting that was held from October 4th to 6th are out. And the key theme of the Reserve Bank of India members in the MPC appears to be a fear that recurring shocks of food and fuel may not be just transitory, but may be in danger of impacting inflation expectations. And hence, monetary policy must give primacy to continuing the disinflation process till CPI gets aligned to the 4% inflation target. Once again, the Reserve Bank members appear to be broadly a little more hawkish than some of the external members, notably Dr. Ashima Goyal and Dr. Varma. My sense is Dr. Bhide is also sharing some of the fears that growth could also be somewhat impacted. But we have the external members to speak for themselves. Joining me now are Dr. Shashanka Bhide, Dr. Jayanth Varma and Dr. Ashima Goyal, all the external members of the Monetary Policy Committee. Gentlemen and Ashima, thank you very much indeed for joining me and in Dr. Goyal's case, joining in spite of being away from Bombay, away from her office. Ashima, actually, let me start with you because you make it a point to say that even if global yields are higher, India need not react with higher policy yields, competing higher interest rates need not be resorted to. Now, as it happens, just 24 hours ago, Indonesia has actually hiked interest rates, not because of their domestic problems, but because of the rising US yields, which are now touching 5%. So do you think that there is a need to keep at least money market rates higher, even if policy rates are not touched?
Risk has come down. And given our sequence sort of capital account liberalization, we have more degrees of freedom than Indonesia. You know, Indonesia during the taper tantrum had such large interest rate volatility because they freely allowed or liberally allowed local currency, borrowing bonds. While in India, it was more a policy decision to raise rates. It was not because of the interest differential. So, and I think we've seen this again and again through the last 2 years, this fears that Indian rates have to follow the US. And we've demonstrated that when we have the freedom, we have buffers, we have the freedom to to intervene in currency markets to prevent excess volatility, and we are able to keep our interest rates attuned to our domestic cycle, growth and inflation, then the country has done well. So I think markets should also recognize this freedom. And for the US, I think that higher for longer conflicts with the stated data dependence. Already we have seen some Fed members saying as yields have gone up so high that they may not need to raise further since markets are doing it for them, right? So I think there is a limit to how high rates can go because we know that corporates need to start borrowing, refinancing their loans taken at very low rates. And as they do it at higher rates, there are all kinds of financial market risks that come.
Yes. And
central banks will be cognizant of those risks.
Yes. No, I take your point on that, but let me get Dr. Varma and Dr. Bhide also that. First to you, Dr. Varma. I'm just asking you, the Reserve Bank has kept or even if it has not kept, liquidity reasons have kept the interbank call rate closer to the MSF rate. It's a good 25 basis points higher than the repo rate mandated by the MPC. Do you think that is called for, given the global turmoil and the competing interest rates from the United States?
I think the statute is very clear that the MPC's mandate is confined to the policy rate, which is the repo rate. And the liquidity management that the RBI does is entirely up to the RBI. It is not part of the MPC.
Yes, of course.
Liquidity management is just a means through which the policy rates that have been set are implemented. So I would not like to comment on, the fine-tuning liquidity operations that are there.
Okay.
So long as the rate is not materially different from the policy rate, I don't think it's a matter for the MPC to comment upon. It's just a question of how they choose to manage the liquidity.
That's a fair point. I will come back to this point, time permitting. But let me get to the recurring statements that are coming from the Reserve Bank members in the MPC. The Governor, Shaktikanta Das, also says that the shocks are, even if they appear to be transient and supply side, they are coming with such force and such frequency that there is a danger of them impacting inflation expectations if they are not immediately attended to. And Dr. Patra waxes eloquent on that. He is clearly worried that these recurring shocks are recurring with such regularity that they are eating into inflation, and inflation in turn eats. I mean, they are pushing up inflation, and that in turn eats into growth. He points out that even corporate sales are falling because inflation is not leaving enough disposable income. Do you agree with that broad thesis, Dr. Bhide, that you can't ignore supply-side-led inflation because they are coming way too regularly?
Well, I think that has been the experience, at least in the last 1 year or so. So we have had these shocks coming externally, and also these weather-related supply disruptions. So I think there is a potential for that. But at the same time, I think the concern is also that they should not get generalized into other prices. So I guess what we have seen so far, at least, is that the shocks that we saw in July and August, they seem to be transitory. But I think there is this potential for the continued effect of this weak monsoon this year on agricultural prices, food prices, and so on. So I think there are basically two concerns. I think one is this climate or weather-related impact, and then of course these shocks relating to the oil price scenario. So I think there is a concern, but it is it is a concern that has a probability attached to it.
Okay. Would you share that worry, Ashima? Because after your MPC minutes were written, we have a fresh problem in the Middle East, and crude is now at $93. And who is to say it could go a little higher if more countries got embroiled in this war? So do you think more caution is called for? This is no time to talk about even an end point to the high policy. We can't talk in terms of lower rates anytime now.
As long as you keep the focus on the real rate positive, and we don't have to worry about recurrent shocks. We will respond to them as a monetary policy. We will raise rates if our real rates are becoming negative, but they are positive currently given our expected inflation. And then we have seen in the past multiple supply shocks, but it has not generalized in Indian conditions. Because we have softness of demand, we don't have a tight labor market, we don't have excessive fiscal spending in the pandemic, we didn't have. And also we've seen in the current survey that household inflation expectations have fallen. We are seeing that core inflation is softening substantially because there are also factors such as slowing demand and global commodity prices fall, other commodity prices falling, that are leading core inflation to fall. So far we have seen that inflation has not generalized the recurrent supply side shock. So why should we think that it will generalize in future? I think that inflation targeting is working. Expectations are getting anchored. Firms' price expectations is always around 4. They see the long run rate of inflation as that. And when they are raising their prices, they're not raising them above that. So I think in India, we're getting used to 4% inflation.
Oh, I hope so. But the remaining 3 quarters for which RBI has given us forecasts, as Dr. Bhide correctly points out, all of them are 5% plus. So we are not really anywhere aligned to the target, are we? Ashima?
No, I think next year the guidance.
Yeah. Next year's guidance is 4.6. Okay.
And in the long run, headline does emerge. So
Okay.
let us see. If you're lucky, maybe this MPC will be able to save that.
Okay. Well, Dr. Varma, would you worry? You know, we were just coming out of the tomato-led, veggie-led inflation. Now again, fuel inflation is knocking at our doors, and we haven't quite put even pulses and rice behind us. The last number, September pulses number was 14%, I think 16%, I'm sorry, year-on-year increase. And even pulses were, cereals were at double digits. So do you think there is a need to persist with liquidity tightening or other means of forcing inflation down?
I think what we have is a real interest rate which is around 1%. That itself is a very strong war on inflation. When you keep the real interest rate at 1%, it has been and point is to keep it there until the inflation keeps coming down. All the signs are that, as Ashima pointed out, inflation expectations are well anchored. Inflation is coming down. You can see that in core inflation. You can see that in WPI. And the other things that you're talking about are spikes. And remember that when there are spikes upward, there are spikes downward. So you can't just talk about a tomato price shock and talk only about a positive shock. There is also a downward shock that happened, unexpectedly lower than what we thought. So these spikes go in both directions, upward, downward, and they cancel out. Okay. What matters is the broader pace of inflation. And what matters is whether monetary policy is sufficiently restricted to keep bringing inflation down. And I think it is. And the effect is being seen that it is moderating demand. It is bringing inflation down. It is anchoring inflation expectations. And that is what is required. And that is what is going on. And we have to persist with that until it comes towards the target.
Okay. Actually, I wanted to ask you, how long do you expect the repo rate to remain at these levels? It's actually a question you are raising. At this point of time, the guidance that the market really needs is not about how high the terminal repo rate would be, but how long the rate would be maintained at a high level. If I pose that question to you, what would your reply be?
I think the answer is very clear, and I think I answered that in the minutes as well. That our target is 4%. Our target is not below 6%. Target is 4%, and we have to keep real interest rates high enough to drive it down to. The way the repo rate can come down is as inflation comes down. As inflation comes down, the same 6% repo rate will become higher and higher real interest rate, and therefore it will have to slide down to keep the real repo rate at an acceptable level. That's how it would happen, and it would be driven by inflation moving towards 4%. A couple of quarters where inflation is below 6% is not reason for a cut. I think that is the message that I think is what I'm talking about in my minutes. Okay. And I'm very clear on that. The goal is 4%.
Okay. I think we need to work that into the headline. That's a very important takeaway, that you are not expecting that the MPC should be cutting rates till you see a decisive move towards 4%, and 4 to 6 is not what is the given mandate. Dr. Bhide, I didn't get your views on the liquidity tightening and the sustained increase in US yields. Now the entire US yield curve from 1 month to 30-year is above 5% or almost above 5%. The 10-year alone is 4.95 or thereabouts. But at one point in time, for a brief moment, even that one went to 5%. So do you think there is a need to be extremely watchful on the liquidity front and keep liquidity tight?
I think, as Ashima said, the real issue is the softness in the demand on the Indian conditions. And so I think the liquidity management is to be consistent with that. I do not think that, as MPC, we would have a role in sort of defining that.
No, I mean, actually, I said this to Dr. Varma even last time. It's not that I'm asking you to take a role in the liquidity, but I'm just asking you, since you are also a seasoned economist, Dr. Bhide, as all your colleagues are, it is something that the Reserve Bank has to do, you think? Otherwise, we would be leading to exchange rate instability. They have to respond with liquidity instruments.
Yes, I think, obviously the interest rate differentials and other global factors, I think would have impact on capital flows and so on. So I think it's a factor that I think the RBI has to manage. So I think that the liquidity issues, the signal that come from these markets, that's something that the RBI would respond to. But as far as the interest rate differentials are concerned, I think the focus would have to be the implications of the interest rates on the Indian conditions.
Okay. Well, I have to take a quick commercial break. I'm back and I will be seeking your comments on a few more things. We have some dangers in terms of our savings rate as well, going to some historical lows. And then there are also worries about unsecured debt getting a little out of hand. Both those are interest rate related questions. So back in a minute after a very, very short break.